Now, I spoke to Mr. Rwani earlier on the show, and he's of the view that this is the time for the monetary policy to actually ease the rate to give room for businesses, to have access to credit. So don't you think he's in the right direction here?
For us, we also believe that in terms of whether it is appropriate to cut benchmark interest rates now, we think it is appropriate, given the fact that the MPC's major policy anchor, price stability, we have seen inflation rates moderate significantly since the beginning of 2017. Inflation rate is now at 12.5%, so that makes the real interest rate using the nominal MPR as a benchmark to be at 1.5%. So in terms of price stability, there is enough justification for the MPC to cut interest rates. However, the CBN governor has persistently mentioned, and even by their actions itself, that the stability of the FX market is very paramount, is the prime monetary policy objective right now. And as you would know, in the past 2-3 weeks, we've been seeing pressures a lot in the number of emerging market economies due to the rising US dollars, as well as rising bond yields in the United States. Over the past couple of months, economic data in the US has shown persistent improvements in fundamentals there. The retail sales data has been on the uptrend. Same thing for the consumer price index data, which has shown that inflation rates in the US right now is now above the 2% target for the US Fed. So it has increased the expectation for further rate hikes by the US Fed. And as a result of that, we've seen some capital flow reversal pressures for a number of emerging markets. So it would appear a bit, it will send the wrong signal to the markets if Nigeria's monetary policy committee is slashing benchmark interest rates at a time when its peers in the emerging markets region are actually increasing theirs. And as we know, money goes where the yields are. So if yields are higher in your country, you tend to attract much more portfolio capital flows. And as you saw what happened in the markets in the last 2 weeks, the CBN has been aggressively mopping up liquidity in the financial system to prevent FX volatility in the markets. At the point in time, they mopped up nearly 600 billion naira of liquidity to prevent that. So for them to be sterilizing liquidity aggressively in 1 week and then turning around in the following weeks to cut benchmark interest rates, it would seem a bit inconsistent. So we expect the MPC to actually retain our policy rate at this meeting.
Okay, so what external risk factor do you think this committee will consider in reaching a consensus? Yes, you've mentioned quite a number of them.
I think the prime external sector risk that they're looking at right now is regarding the capital flow reversal pressures from a number of emerging markets. Although on the positive side, we have seen increases in oil prices. The Brent crude touched a 4-year high, nearly 4-year high of about $80 per barrel last week, driven by the renewal of sanctions by the United States on Iran, as well as the subsisting impacts of the production cost agreement by OPEC member, which has shrunk inventory level in the US. So although there is a positive driver for external sector stability in terms of the rising oil prices, the fact that we're in a very volatile, or should I call it a risk-off emerging markets investment environment currently, would make it a bit inappropriate for the MPC to start cutting benchmark interest rates. Although there's a very good argument that although the benchmark has been at 14%, market rates has moved far above or far below the benchmark in terms of pricing and inflation expectation. Currently, the 12 months bills at the market auction, at the PMA auction, is less than 12%. So then the benchmark interest is still at 14%. So there's really enough incentive for the central bank to begin to narrow the spread between market rates and the benchmark interest rates. But considering the fact that cutting benchmark rates in this environment will send a wrong signal to the financial markets, both local and foreign investors, we think that on that basis, the CBN would probably retain our policy rate at current level.
Now, if I may ask, what in your opinion will be the trigger for this much expected rate cut?
I think the trigger would be when we start seeing foreign direct investment being a driver of foreign portfolio, of capital importation into the country. Currently, if you study the last 4 or 5 quarters of capital importation data, right from when we introduced the high and hill window, the major driver of capital inflows into the country is foreign portfolio investments. And where are they going to? They're going to short-term investment opportunities, money markets, securities, and they're going to the fixed income market, the bond markets as well. And these are hot money. Anytime there is any trace of instability in emerging markets, when we are seeing development in monetary policy in advanced economies, we tend to see a reversal in these flows, which can cause volatility in the fixed income market, which the central bank is very particular about, because fixed income, because the FX rate is a major driver of inflation as well, price stability, which is their second major monetary policy anchor. So for them, they would like to see investor sentiments fully back in terms of FDI inflows into the economy, and they also like to see greater policy stability, because currently foreign investors are pricing in the anticipated volatility in the economy as we approach the election. The pricing into the securities pricing, which is why you will see that the flows, the capital flows in the last capital importation data that came out, we saw a rebalancing of foreign investors' exposure from the equity market, which is more risky, to more short-term money market securities. So all these risks, the CBN would like to see them substantially reduced before they take the initiative and then start cutting the benchmark interest rates.
Now, in all of this, where does the fiscal policy play a role?
Fiscal policy is very important because a number of reforms necessary to allow for a fully functional and market pricing of FX rates in the economy depends on fiscal policy action. One of them is the downstream oil and gas sector, and even the power sector. Like I mentioned before, the CBN would like to see FDI coming back into the economy. But for indirect investment, it is dependent on the available long-term opportunities in the economy. And long-term opportunities in the economy are created by structural reforms. Structural reforms are driven by fiscal policy actions. So for the MPC or for the central bank, they would like to see much more deeper commitments to structural reforms by the federal governments. And that includes looking at the downstream oil and gas sector, looking at the power sector, looking at the fiscal viability of some national governments. Right now, as of today, many of the state governments are very close to insolvency. So they would like to see, greater stability in financing for the subnational entities, so as to improve the long-term growth prospect of the economy. All
right, thank you very much for your time, Omotola. Omotola Abimbola is one of the investment analysts at AfriInvest Securities. Well, we'll take a quick break now. When we come back, we'll look at the agricultural sector. Just stay with us.